Federal Reserve Chairwoman Janet Yellen is helming her 13th Federal Open Market Committee meeting on July 28th and 29th. It's been roughly 18 months since she took over the Fed's top post from Ben Bernanke. The Wall Street Journal's Ben Leubsdorf looked at a few key numbers to compare how Yellen's first year and a half on the job helming the U.S. central bank compares with the early experience of her predecessor. Both saw double-digit percentage stock market gains in their first 18 months. Hiring has been strong and the unemployment rate steadily fell. But that's where the similarities end.
There are changes in the assessments of the economy and forecasts for the economy that would point in the direction of downward adjustment.
Even though the recession officially ended several years earlier, in her first 18 months, Janet Yellen has faced an economy that has struggled to emerge from the grip of the Great Recession. Consumers have been reluctant to part with their cash, keeping the inflation rate well below the Fed's annual 2% target. Inflation ran above the target in Bernanke's first 18 months. In the bond market, the 10-year Treasury yield moved in opposite directions under Bernanke and Yellen in their first 18 months. And that brings us to interest rates. By the end of Bernanke's first 18 months, the U.S. was still a year away from plunging into recession, and the Fed pushed interest rates higher 3 times. By the time Yellen was in charge in February 2014, there was some economic recovery, but not enough for the Fed's liking. The Fed had dropped short-term interest rates to near zero in 2009, and Yellen's Fed has continued voting to keep them there until further notice. Could that further notice be coming later this year? The economy is growing moderately, prompting Yellen, economists, and even a few Fed presidents to drop more than a few hints that we can expect a rate hike for the first time since 2006, possibly when the Fed meets again in September, or wait until December.